All right, welcome everybody to today's Able United webinar. Today we're going to talk about financial literacy. In case you didn't know, April is National Financial Literacy Month, and to celebrate, we wanted to provide some education on investing and saving, specifically saving and investing with Able United. My name is John Finch. I'm the director of Florida's Able program, Able United. It's administratively housed under the Florida Prepaid College Board. They kind of provide oversight for the Able United program. We launched July 1, 2016. Prior to joining the Florida Prepaid College Board, I spent about 10 years at the ARC of Florida, which is a statewide advocacy organization for individuals with intellectual and developmental disabilities. And so I kind of brought in that social work background into the Able United program. But today I'm not alone. I'm joined with Callan Associates. Callan, they are our investment consultants for the Florida Prepaid College Board, as well as the Florida Able Board. And they really help us and provide guidance on investment policy structure and strategy, risk, and just helping us select investment managers. From that team, I have Weston Lewis. He is a senior vice president at Callan's Atlanta Fund Sponsor Consulting Office. Weston works with a variety of fund sponsor clients across from the Southeast region, including defined plans, defined contribution plans, insurance assets, endowments, and foundations. Weston received his bachelor's in economics from Wake Forest, and he also is the holder of the right to use the Chartered Financial Analyst and Chartered Alternative Investment Analyst designations. He's also a member of the Atlanta Society of Finance and Investment Professionals. Weston, good morning. Thank you.
Morning.
Thank you for joining.
Yeah.
Also, we have Brian Smith. He is a senior vice president as well at Callan's Atlanta Fund Sponsor. He joined the team a few years ago, but before that, he spent 11 years as a director of institutional services at Atlanta Capital Management. There, he co-managed multiple business units, including client services, consultant relations, and new business development. Brian has a BS from Spring Hill College and an MBA in finance from DePaul University. And he also holds the right to use the Chartered Financial Analyst designation. He's also a certified public pension trustee in the state of Georgia. So, Brian, thank you for joining us as well.
Well, good afternoon and happy to participate.
Great. So let's just go over some housekeeping slide here. All of you have joined the webinar in listen-only mode, which means you're muted. So if you want to ask questions, there is a box there where you can go ahead and start typing your questions. And we encourage people, as you have questions throughout the presentation, feel free to use that box. We'll have a couple times during the presentation where we'll stop and answer some questions as long as they're relative to where we're at in the program. And then at the end, we'll kind of open up the door for any kind of questions and answers you might have about Able United or investments. Also, maybe you could have a question later. You'll be getting a follow-up email from us with our customer service contact information, and you can always reach out to them, and we'll have that as well as at the end of the slide of how you can reach those individuals. You'll also notice on this box there'll be some handouts you can download, including today's presentation for you to review and follow through and download, keep that offline. And then also our program description and participation agreement that really goes into the nuts and bolts and the details of the Able United and the contract itself. So let's kind of high level go just an overview of what we hope to achieve today. So here's our kind of objectives. We're going to tackle what is Able United. There might be people online today that are not familiar with our program, so we'll kind of do a high-level overview of that and how that program works. Then we'll dig into Investing 101. We'll do some basic, just what investing is, what is risk involved with investing, and then we'll do a deeper dive into the Able United investments options and kind of answer any questions you have there. And once again, we'll have a Q&A section at the end. Once again, if we don't answer your question, we hopefully will be following up with everybody individually to make sure your questions are answered. Also, just to let you know, there will be a couple polls throughout the presentation to get a better understanding to make it a little more interactive and get a better understanding of your knowledge about Able United investments. So we'll go ahead and launch that now. We'll launch our first poll here. just to how familiar you are with Able United. Maybe this is the first time you've heard about our program, or maybe you're an old friend and you have Able United account, but really want to just get better knowledge about our investment. So we'll just leave this, give everybody a couple minutes to go ahead and answer their question, to answer the poll question. Give everybody a few more seconds here. All right, thank you everybody for participating in that poll. And I'll go ahead and I'll show you the results from that real fast. So a majority of you are somewhat familiar. 63% of you have heard of us and received our email. Maybe you're on our email list. And a handful of you are very familiar. So you probably have an account and you're here to learn some more about our investment options. So that's great. So we are glad you are here today, and let's go ahead and get started. So what is Able? And Able started a little over a decade ago when Jen Sikora in this picture here and her son, who was quite younger then, just a little 3-year-old, wanted a way to save for their child with a disability, similar to the way they were able to save for college expenses for their typical children. And so through the work of Jen and other parents out there, this came to fruition in July of late December of 2014, when President Obama signed the Achieving a Better Life Experience Act into place. And what this act is, it allowed states to create savings and investment programs for individuals with disabilities to kind of encourage them to save private funds to support health, independence, and a quality of life. And what this law did was it created a new section to the Internal Revenue Code, Section 529A. Here in the state of Florida, we launched the legislation to get our program started, happened in July of 2015. We launched July 1 of 2016. Since then, we have over 1,900 individuals here in the state of Florida who have enrolled in Able United accounts and have contributed over $9 million to the program to help save for a better life experience. So how does the program work? Who's eligible? And just getting the nuts and bolts. So like we said before, Able United is a tax-advantaged savings account to help support disability expenses with some key unique benefits, specifically being able to maintain government benefits. So who's eligible? We have 3 eligibility requirements. The first is that the individual with a disability must be a Florida resident at the time of the application to enroll. So this is Florida's Able program, and we were created and we're funded by Florida taxpayers, and so we are open up just to Florida residents. Now the other 2 is true for all Able programs, as various states are opening Able programs either for their residents or national programs, and we all have to follow these same federal guidelines. First is that the individual has to have what they call a qualifying disability. And this is someone who's entitled to receive government benefits based on their blindness or disability under Title II of Social Security, which is Social Security Disability Insurance, SSDI, or Title 16 of the Social Security Act, which is the Supplemental Security Income, which is basically a monthly check for individuals that have a disability or low income or elderly. If you're not receiving government benefits or eligible for those government benefits, you could be on the Social Security Compassionate Allowance list for various disorders, diseases, and ailments. Or you can declare your disability saying that this individual has a medically determinable physical or mental impairment that has resulted in marked or severe functional limitations. Some examples could be individuals with Down syndrome, cerebral palsy, people with autism, just to name some few. The IRS has given us some additional guidelines, and so during the registration process, you can kind of select the type of disability and why you meet the severity limit. Also, we have a handy-dandy eligibility wizard. You can go to our website, ableunited.com. There you can take the eligibility wizard and kind of help point you direction to see if you're eligible for an Able United account. The next is the age of onset. The age of the disability had to be diagnosed prior to age 26. So that's also unique. So you can be 75 years old, but if your disability was diagnosed at 20, you would be qualified for an ABLE program. It's just a matter of that disability occurring prior to the age of 26. So if you meet the requirements, how do you enroll? Our program is completely online. So you would go to ableunited.com. You wouldn't go to a bank, you wouldn't go to a financial advisor to enroll in our program. This is run by states. Some states have it through the Treasurer Office. Here in the state of Florida, we're run through the Florida Prepaid College Board Office. And so you would visit ableunited.com. You would hit enroll. It takes about 15 minutes to open the account. You would, just like you would set up any other kind of online account, you're going to ask for some information of who you are, email, contact information. We'll also require some specific information about the individual with the disability, such as why they're eligible. It takes, like I said, 15 minutes. There is no documents or approval process, so you're not going to be loading up or mailing in documents to be approved. It's all a self-certification process that you meet the requirements and can enroll. So once the account is open, you can begin contributing to it. You can save up to $15,000 per year, and that can be from the individual with the disability. It can be from family, friends. It can even be for organizations. So anybody can contribute, and it's maximum $15,000 from all sources. So, for example, let's say Weston, who's on the call today, was very generous and decided to contribute $5,000 to your ABLE account. Thank you, Weston, for your generosity. And then maybe mom and dad kicked in $5,000. The most that can go into that account for this calendar year is an additional $5,000 for a total of $15,000. And so that balance carries over every year if you don't spend it, and then you can also contribute additional $15,000 each year moving forward. So when you open the account, you're going to select how you want to invest, and we'll really dig into our investment options here in this next portion. But we have 7 different investment options, some pre-designed ones for the people that want the system to do it to yourself, or some customized portfolios you can do yourself if you're a little more familiar with investing, and we'll dig into that. And then finally is you got money in there, it's growing, maybe you want to take it out and use it for one of those qualified disability expenses, which we'll speak about on the next slide. But you can take the money out at any time for any reason. So if you put money in today and you needed it 2 weeks down the road or 7 years down the road, you have the flexibility to take the money out as you see fit. And you can do this either through an ACH transfer to, let's say, a checking or a savings account, or you can request that the system cuts you a check. And then hopefully in the future, we'll be offering a prepaid card as well that you can use as a more frequent way to transact. Generally, funds in or withdrawn from an ABLE account for qualified disability expenses, with some exceptions to those receiving SSI, will not negatively impact your benefits. And once again, there'd be no tax on the growth of those withdrawals on the earnings on the account, as long as you're using it for qualified expenses. So why am I saving money in an ABLE account, and why am I taking money in and out? So what you're using these accounts for, and the purpose of these accounts, is to save for what they call future qualified disability expenses. These can be wide range. The Treasury has given us several different options here of what a qualified disability expense is, but also includes basic living expenses. You can see on here it can be health, education, housing. As long as you can justify that the expense relates to the person with a disability and helps them achieve a better life experience by improving their health, independence, or quality of life, then it will be a qualified disability expense. We encourage you, the beneficiary or the account administrator, to keep the necessary documentation so the IRS or Social Security, if they requested information, that you would have that on hand. Most likely some things are not going to be qualified, such as gambling, alcohol, some forms of entertainment, and giving the funds away, because these accounts are really to help individuals gain a little more independence and a better quality of life. And then we'll touch on this last slide here before we get into investing about what if you're receiving government benefits currently? What if you're receiving supplemental security income, that monthly check we talked about? Generally, funds in or withdrawn for an ABLE account are disregarded when determining eligibility for SSI. Now, there's a couple of exceptions. First is the first $100,000 in ABLE account does not count as a resource. So if you're contributing $15,000 a year and then several years down the road you hit $100,000, once you hit that, anything above that will count towards that resource limit. But if your ABLE account causes you to go above that $2,000 resource limit that SSI has, your SSI will be suspended, but you'll still be eligible for Medicaid services or Medicaid benefits. Also, if you're using your ABLE account to pay for housing expenses or and you're receiving SSI, if you withdraw money from your ABLE account and retain it past the end of the month, the beginning of the next month, Social Security will count those funds as a resource, even if they're made for qualified housing or non-qualified expenses, will count as a resource. So we usually tell people if you're on SSI and you're using your ABLE account to pay for housing, just have your account cut that check directly for payment for housing-related expenses, or withdraw that money and expend it in the same month. If you want some more information, we have a link on here, and it's also in the handout. You can jot down this link. But this is what the Social Security uses, their internal manual to kind of govern ABLE accounts. So if you have more questions, that's a great resource for you to go to. So that is ABLE United in a nutshell. That is our program and how it works. And so we really want to go into this investing section. But before you do, let's go ahead and do another poll real quick, just to kind of get an understanding of why you're on today's call today. Maybe you want to learn just a little bit about ABLE United, or what specifically you want to know about investing. And that will help us just, get a better understanding of who's on there. So if you could just take a minute there, if everybody can click on the screen on why they're here, that would be very helpful. Give everybody a few more moments here to answer if you haven't had an opportunity. All right, we'll go ahead and wrap that poll up, and then we'll get started. So looks like a majority of you are all over the place. About 40% wanted just some general information about ABLE United, and 60% of you or so wanted to know more just about varying investing, whether it be investing for your child or just some general information or more detailed information about our investment options, which we'll be covering. But before we go forward into the investing, our legal has made us to put a disclaimer up here that the presentation you're receiving today is strictly for informational purposes. This shouldn't be construed as legal, investment, or tax advice in any manner. We always recommend to talk to one of these legal professionals, an attorney, about your unique situation. That the statements you're seeing are opinions or hypotheticals, which are made to this day or expressed, are not statements of fact and merely illustrative. So please look at this disclaimer. At the end of the day, this is just general information, and if you have more specific questions, we recommend talking to a professional to help you with your situation. So we're going to take this slide here, and as we talk about investing and bringing Weston on, we get this question a lot on previous webinars when we go face-to-face meetings. What is investing? Can you just break it down to us in some layman terms of what does it mean to invest?
Yeah, I typically think of investing as a little bit different from saving, as in kind of our plain language. So if you say I'm saving up for something for the next year or so, that I typically think of that as saving. But when we talk about investing, oftentimes we think of investing as something farther on down the road that you're saving for, and you're putting that money into into something that can earn a rate of return. So as we think about investing, really there are two main things that you can do to earn a rate of return. You can either purchase ownership of something, or you can loan money to someone or something. So as we look at equity and stocks, you're purchasing generally an ownership of a company or a corporation. And if you purchase a share of stock, this entitles you to a share of the profit of that company. Bonds are a little different. So bonds or debt, they're a little bit different. You're loaning money to, as I mentioned, someone or something. That something can be the United States government. They issue a lot of debt. People loan them money, and they finance certain things. You can also loan it to a company. That company says, hey, we need to buy this widget or that, and so you loan them money, and they pay you back at a later date with a little more interest. Or you can loan money to a pool of people who have purchased homes, and so you're loaning them money to purchase those homes. So the general concept is that you're going to get that principal back at a later date with a little bit extra that we call interest. So we've classified equity and debt. In this program, at least, you're not really buying a single company. You're buying a larger group of companies, and we further break down that kind of group of companies into those that are U.S. based in the United States, or those that are based out of the United States. So when you invest in U.S. equity in the program, you're investing in a broad kind of collective basket of U.S. equities, and when you invest in non-U.S. equities, you're investing in a basket of non-U.S. based companies. So does that make sense so far, John?
Yeah, I think that's great. I think that kind of really breaks it down. And then I know we have a bullet point on there about cash and money market, and that's really not investing per se, right? When you put money in a money market or an FDIC kind of option.
Well, it can be. It can serve a role, but typically, if you think, hey, my goals are a long way off in the horizon. There are a lot of people that do this, and they're just afraid of the possibility of losing money, and they will put it into something. But generally, if you know that you are not going to tap into these funds for a while, a lot of people decide that, hey, we're gonna accept the risks that come with the various instruments, and so they can play a role, but typically, and also too, as I mentioned, with cash, with money markets, you're still loaning someone money, or a bank money, or whatever it may be, but it's just for a lot shorter period of time. So when you think of the debt that's on the right hand side of this page, typically, that can be a 10-year obligation that they have to pay you back the principal plus interest in 10 years, or it can be a 30-year. But typically, when we think of cash, it is very short term. It's something less than 1 year. You'll get your money back.
Okay, good to know. So what are some important things to know about investing? Like, how does and I'll pull up the next slide here. Can you kind of explain, what happens when you're investing in these returns?
Yeah, this is compounding interest is a fundamental investment concept. Albert Einstein called compounding interest the eighth wonder of the world. And then there's an old adage in our business that those that do understand compounding interest are destined to collect it, and those that don't are destined to pay it. So it's not a hard concept to grasp. And just if I could think of a quick example, let's say you invest $100 and at the beginning of the year, and at the end of that year you had earned a rate of return of 10%. Well, now you've got $110 in your account at the end of the year. Well, you decide to invest again the next year. Well, not only do you have that original $100, but now you have 10 extra dollars actually earning this rate of return for you. So at the end of that year, if you earned another 10%, you've got $121. So if you think, all right, what does compounding do for you? At the end of 5 years, if you had earned that 10% rate of return, it would be $161 rather than kind of $150 if you think of. So that additional money, that additional interest is compounding on itself and earning more interest. So the key takeaways from this are that compounding interest is really sensitive to two things. Number one is time. How much time does that money earn kind of that rate of return? And then number two, the other sensitivity is the actual rate of return. What can you get with your investment? So we've put together a couple of examples. That is a picture of me with the twin brother that I didn't know I had before we put together this presentation. So there's Weston number 1 and Weston number 2. And let's say that when I graduated college at age 20, my dad came to me and said, hey, you know, I'm going to give you $10,000. You put it in an account, and then when you're age 40, you can buy something neat like a sports car. Just grasping for examples here. So Weston number 1 immediately put it in and was able to earn a 7% rate of return, and where I am today at age 40, now I've got $38,000 in my account to buy a car. Well, with Weston number 2, he waited until he was 30 to put his money in the account and to start earning interest, and so he only had 10 years of investing, whereas Weston number 1 had 20 years to invest. And now, at age 40, he only has $19,672 in his account. So whereas one is able to buy the Lexus, the other is able to buy a used Honda. John, do I still have you?
Yeah, that's a great point. I really does lay out what the importance of time is in when investing long term. But what's the next important thing? So time, I know, is a key factor. But what else is important?
Yeah, so I mentioned the rate of return is also important. Here in this example, we have Brian. He also has a twin brother that he didn't know he had. But Brian, his situation was a little different. When he was 20, he got married, and his wife came to him and said, you know, we're probably going to have kids one day, and we want them to go to a good college. We should probably start saving. And so they put $10,000 in an account, and Brian number 1 was, you know, really concerned about losses and everything, and so he wanted to be very safe with his investment, and so he earned 3.5% on his investment. And Brian number 2, they both started saving at the same time. Brian number 2 decided, hey, you know, I want a higher rate of return. I'm willing to accept the risks, and so he was able to get that 7% rate of return, and now he's got $54,000 that can go towards the college tuition. So you see, kind of in these two examples, the first being having an additional 10 years to compound that interest, and then the second, just achieving a higher rate of return, how it can lead to a lot more on that bottom line of, you know, Brian number 2 having 54,000 versus Brian number 1 having about 24,000.
That's interesting. And, as we're thinking about investing, and something we hear quite often from people that maybe Able United might be the first time they're really investing anything or have the flexibility to invest that Able United offers. And so the question we get is what is risk? Like, why, I'm concerned about investing. It could be there could be challenges. And so can you just give us a little bit more information about what risk is and how, just to get a better grasp of what that means?
Yeah. So I think, as you think about that equities versus debt that we talked about at the beginning, is why would you favor one type of investment over the other? And really, risk and is what it boils down to. Equities tend to provide a higher rate of return relative to bonds and relative to cash, but it doesn't always seem that way. You're going to go through long periods where you look like equities have returned less, and so, or you can put your money in one year and the next year you look at that and it's almost been cut in half. So really, this is a key component of investing and knowing what is your risk tolerance, how much can you lose, or how long can you wait. So really, remember when I said early on that equities entitle you to some share of the profits. Well, what we know is equities don't always, or companies don't always turn a profit. Sometimes they do, sometimes they don't, and you go through cycles. And so with this, we looked at just the growth of a dollar over time. And what this is telling you is that if you look at the very left-hand side of the chart, this is a broad basket of U.S. equities represented by the red line. If you had put $1 in, at the end of the first, call it 2 years, you would be thinking, wow, this is great. I put $1 in, and 2 years later, I've got $1.50 in my account. Well, you would have been a little bit disappointed because it would have taken you about 10 years to maintain, to get back to that $1.50 that you had. So as you look at, if you say you were an investor at the beginning of 1998, and you look at this and you roll all the way to 2008, you'll note that at the end of 2008, you still had only $1 in your account, and you had gone on this roller coaster ride of ups and downs, and then at the end of 2008, really you see this broad basket of U.S. stocks go up quite a bit. So there's a lot of fluctuation. There's a lot of uncertainty baked into equities. This green line is what is more of a broad basket of debt or a broad basket of bonds. And you'll note that this is a little bit more stable. It moves more in a straight line. But for 20 years, that $1 that you invested is now $2.6 after the end of 20 years. For equities, that $1 that you originally invested is now worth $4 after the end of 20 years. And then finally, the third kind of grouping that we had at the bottom of that first page on the different types of investments, this 3-month T-bill, this largely represents a cash return. So cash is the one thing that we know doesn't lose money, but if you look at the last 20 years, it really hasn't made all that much money. But it is certainly far more stable. So you have to think about, what is my time horizon? What is my ultimate goal? and what are we trying to achieve with this account and setting it up. Does that answer some question about risk, John?
Yeah, I think so. I think it gives people a greater understanding of how, when it comes to equities, for example, and we'll even bring up this next slide here to kind of see that is, they're a little more volatile or they're variable depending on how companies do in the market. Bonds are a little bit more stable, but the return isn't as great or potential. So can you explain a little bit about this chart and how that risk plays out across years?
Yeah. We actually call this our periodic table of investment returns, and all we're doing here is we're ranking the various asset grouping or asset classes by their return. And if that return falls below that black bar in the very center of the page, that signifies it's been a negative return for that calendar year. If it falls above, it's a positive return for that calendar year. And as we saw in the previous chart with the growth of $1, this just shows it year by year, and you see it kind of the equities, which are in the two blue boxes, both U.S. and non-U.S. stocks. Those kind of go up and down across the page. Sometimes they're on the top, sometimes they're on the bottom. The bonds, which are in green, those are more, you see a little bit more stability there. Rarely are they on the top. Some 2 years they have been, but more towards the middle of the page. And then finally, what's in the gray with the 3-month T-bills are cash and money market type investments. You'll see those rarely ever. They're meant to never lose money. But they're also never on the top in terms of the outperforming other asset classes. So it gives us a sense as to that variability that we're trying to tease out here and show you all that it's not certain that stocks will give you more money, but they do offer the opportunity for more. And as we think about, all right, what if, and I gave you Brian's example of the different rates of return. So had you been an investor at the beginning of 2008, and you said, you know what, I like U.S. stocks, and that's the place that I want to be. Well, at the end of 2008, your account would have been cut by about 37%. Had you cashed out there and said, you know what, I throw up my hat, I'm done with it, your account would have been worth about 63% of what it was the year before. But had you stuck with it, you would have earned a 10-year rate of return of about 8.6%. And remember what I said about compounding. The more time that it has in there, the more time it has to grow at a rate of return and really build upon itself. Had you invested in bonds, you wouldn't have seen really that downdraft. And at the beginning of 2008, you would have seen a pretty decent return of 5.2%, and it would have built upon itself. And that over the last 10 years has earned about a 4% rate of return. So as we think about the differences between that Brian number 1 and Brian number 2, Brian number 2 had gotten closer to that 7% rate of return, whereas Brian number 1 had gotten close to that 3.5% rate of return, and number 1 had about half the amount of money in his account. So really, it's to some degree accepting that variability or that risk is what is required for investing in equity, and for the hope of getting paid a higher rate of return. And I hope that has explained risk in an understandable manner.
Yeah, I think you do a great job, Wes, and I think it really gives people a better idea of what investing is, an understanding of what risk is and how it varies year to year, and I think that you did an exceptional job. Let's kind of switch gears a bit, and let's really get into the Able United investment options. I know this was, as people are looking at Able United for the first time, or maybe already have an account, just a better understanding of what we offer as a program. Can we bring Brian on to give us a little more discussion on our investment options?
Sure, absolutely. Thanks, John, and good afternoon, everyone. I certainly appreciate the opportunity to address any of your questions and thoughts throughout this presentation. Let's take a moment to kind of walk through the menu of investment options for Able United, and there are a total of 7. They're simply divided into one of 2 categories. It's the Do It For Me option, which are the portfolio options or pre-designed, fully diversified portfolios. And then there are the Do It Myself options, which are referred to as fund options and include individual funds for stocks, bonds, and money market mutual funds. So let's start with the Do It For Me option. And these are really options designed for those investors that are reluctant to make investment decisions on their own. They like to make one choice and basically set it and forget it. The second type of options are the Do It Myself options. And those offer a greater degree of choice as well as a greater degree of overall flexibility. So one of the benefits of the Able United program is you have the ability to self-determine which group you consider yourself in. So let's take, for example, the Do It For Me options. These are the 3 pie charts in the middle of the page, and they include a diversified mix of options utilizing the underlying funds of the fund options, and they span the risk-return spectrum. They start with a conservative option, they move to a moderate option, and then conclude with a growth category. And at each step in this process, the potential return, as well as the investor's willingness to bear risk, increases as you move from conservative to moderate to growth. So as opposed to selecting each one of these options based upon your own individual risk tolerance, you can also choose them based upon your investment objective. So for example, for the conservative option, this option emphasizes current income and greater stability by the way of having a higher allocation to bonds, which are less likely to fluctuate in value in comparison to equities. In comparison, the growth option emphasizes capital appreciation by the means of having a much higher allocation to stocks. So in order for an investor to be comfortable investing in the growth allocation versus the conservative allocation, you really need to be comfortable with the fact that you might lose money in the short term due to your pursuit of seeking a higher rate of return in the long term. If we turn our attention to the fund options, these are the 4 strategies of mutual funds identified as the international stock, U.S. bond, and money market mutual fund. And these are the Do It Myself fund options, and they really allow you to customize your own investment strategy based on your underlying circumstances. So, for example, you will have control over setting the asset allocation amongst these individual options, and you have the determinant to pick between a higher risk option like international stock fund or a lower risk option being the money market fund. Now, Able United, they offer pre-designed portfolio options really because those pre-designed options, and John, if you look at the diversification page, which is the periodic table, we include those pre-designed options because they certainly help smooth the ride. So don't hold me to this, John, but I think Warren Buffett has had a quote that he much prefers an investment that generates a 15% rate of return, although it has wide fluctuations in value, over an investment that generates a 10% rate of return that has a very stable year-over-year return generation capability. Now, we're not all Warren Buffett, not all billionaires like he is, so the ride matters for most investors. So while all of the Able investment options involve some degree of risk, which includes the potential for the loss of principal, some investment options, such as non-U.S. stocks and U.S. stocks, they involve more risk than other options like bonds. So those higher risk investment options, they have the potential to earn higher returns, but they also have the potential for greater losses. So if we look at this particular graphic, let's compare a few of the investment options. If you look at the teal box, which is non-U.S. stocks, and I point you to the far left, that is calendar year 2008. And in 2008, non-U.S. stocks fell by approximately 43%. From a broad perspective, non-U.S. stocks tend to either rank at the very bottom or at the very top. So the year following, in 2009, non-U.S. stocks were up almost 32%. So in terms of risk or volatility, non-U.S. stocks tend to be one of the more riskier investment options in the investment program. If you look at the orange box, which is the pre-designed growth allocation, that has an allocation of approximately 25% to non-U.S. equities. And because of that, they also suffered losses in 2008, similar to non-U.S. stocks, but to a lesser degree. They also suffered losses in 2011. If I point you to the dark blue box, which is the pre-designed conservative portfolio, you'll see that it has the smoothest ride over all of the time periods, meaning that it ranks nearly in the middle of all the other boxes. Albeit the trade-off, while it has a smoother ride, it's also generated a lower rate of return in comparison to the other pre-designed options of moderate and growth. John, do you have any questions?
No, I think that does a great job of kind of painting the picture of where we've come from to where we go, and seeing it in this graph format really gives you an idea of those that, for example, like you said, the growth portfolio, yes, there's more volatile, but there's higher chances for return as well. And so, the question we get is, let's say I'm doing growth and I have a small child, and hypothetically I'm putting funds in them and I'm all in the growth portfolio allocation. But what happens when they start to become an adult? They're 18, they're 20, they're going through transition services. Am I stuck in that situation forever? Am I locked into the growth portfolio? And the answer is no. we get this question a lot when this ABLE program was established on a federal level, when they were putting the laws into place. They did allow for what they call rebalances to happen twice a year. And what that means is the funds that you currently have invested in the program, whether it be 100% growth, or maybe you're on the conservative option, but now you think you have more longer-term goals and want to change it, those underlying, whatever you're invested in the market, you can basically reorganize that, restructure, the terms rebalance, those funds into a different option twice a year. And so you can do that up to twice a year, and then those reset every year. You get those 2 rebalances, and that is a federal requirement. But also, maybe you want to change how your money going into the account is allocated. So maybe you open the account and did 100% into the moderate option, and you go, well, no, I think I'm going to take a more aggressive approach, and I want to, for the next several contributions I'm making to the account, maybe I want to be a little more aggressive with that. Well, you can change how those incoming funds are being allocated to your account at any time. And so there is no limit of how you redirect incoming funds into the various fund options or investment options that we offer. So that's kind of the difference between a rebalance and a reallocation. Another common question we get, another frequently asked question we receive is, can you just tell me how to invest? You know, what's best for me or my child, or how much should I invest? And I'm not a certified financial planner, and I can't give you that advice, but we will kind of give you some hypotheticals here in a moment. But you know, there's just some common questions you need to ask and talk to a financial advisor about, because there is no one size that fits all. It really just depends on your unique situation. So consult with that financial advisor. But kind of think about what the purpose of the account is. Are you saving for long-term, short-term? Are you going to use this for daily living expenses, or maybe you're thinking of saving it for a future car? Or also determine your risk tolerance. We just talked about risk and the variable and what you're comfortable with. And then you can choose, do you want somebody else to kind of build this for you, or do you want to kind of build your own? And once again, you can review this program and this policy with your financial advisor. And so I'll turn it back over to Callan. It's kind of the hypothetical decision chart we have here. Can you give us a little highlight of what this all entails?
Sure, John. This is Brian Smith again, and I really like this particular graphic because I think it's a tool that individuals can use for them to self-determine their own investment strategy, as well as which investment options they should use. And I look at this particular graphic, I really think there are 4 key variables that will help you determine which investment options you should pursue. The first is your cash flow needs. The second is your risk tolerance. The third is your investment horizon. And then lastly is your return objective. So let's start at the far right of this decision-making tool chart. It's labeled B. So if your primary purpose of utilizing the ABLE plan is as a savings account, meaning that you allocate dollars to the account and you draw those dollars down to pay for expenses, and when it becomes low, you reallocate and increase the overall dollar amount to the savings account, I would think that's a high cash flow need type investor, meaning that you likely have a very low risk tolerance, you have a very short-term investment horizon because you depend upon those monies to pay expenses on an ongoing basis, and you're very pleased with earning a interest-bearing account type rate of return that's available for savings accounts. So if your investor profile is similar to that type of description, you would most often utilize the money market fund as well as the soon-to-be introduced FDIC insured savings accounts as well. Well, hypothetically say, well, what if you have lower cash flow needs? meaning that you don't have to depend on these monies to pay ongoing expenses. So your withdrawal rate on an ongoing basis is fairly low. It's a small percentage of your total account value. Or potentially you have a large expense sometime way out into the future. So your investment goal or strategy is really a more capital appreciation, or it's income and stability in comparison to the overall option of the savings account that have short-term cash flow needs. So overall, again, you would have a much higher risk tolerance. You have the ability to withstand short-term losses in pursuit of those higher long-term rates of return. You have a much longer time horizon, and your overall goal is to generate a much higher rate of return. So what are your options? Well, you would have to decide, do you want to utilize the do-it-for-me investment options or the do-it-myself options? And as I mentioned previously, the do-it-for-me options really are that set it and forget it. They are the portfolio options of conservative, moderate, and growth. And the key benefit of these types of options is that the overall asset allocation is predetermined and remains static. It does not change, meaning that rebalancing the underlying investment funds is the responsibility of Able United, not the investor participant. In comparison, the fund options of the money market fund, U.S. bond fund, and the stock funds, those are the do-it-myself options. So you have greater flexibility and choice. And you, as the investor, determine the percent allocation amongst those four investment solutions. And it also requires you to periodically review your investments and make appropriate changes to the total asset allocation across those funds.
That's great, Brian. And I know we're getting pretty short on time here, but great decision chart. Once again, download the handout if you haven't. This will also be available. We'll be sending a copy to everybody at the end of this presentation as well. But moving on, just for the sake of time, investment returns. How do I check out my performance? You can go to your account, log on, see some account documentation we give to you quarterly. Also, you can go to our website to see the recent performance. So just high level on the investment returns, you can kind of see for the last couple of months, the market's been down a little bit, but for the quarter, it's slightly down. But then if you even look at the 1 year return rate or since inception, there was overall positive returns on all the various options. I encourage you to go check out those performance summaries on our website, as well as looking at your specific account information, how your investments are doing on our quarterly account statements, which you can download on your site. We'll touch real fast on how much does it cost. No cost to open and maintain an account. You can open an account for free. There's no application fee. There's no minimum to open the account. If you do want to make an electronic deposit, like through an ACH, there's a $25 minimum to do that. There's an optional $10 annual paper fee if you want to receive paper statements instead of just going onto your account and getting the PDF file. And then also there's an investment administration fee that's taking out of the returns. And so you don't really see that fee, but those are the fees associated with the various fund options. We have about a minute or two to do some questions and answers. I'm looking at the questions panel. I don't see many questions. And like I said, go ahead and put your questions in there if you do have any. We will reach back out to you. I know one of the questions we often receive about Able accounts and investments, I think we kind of covered all that. But if you have something unique, definitely give us a call at our customer service or send us an email or respond to this email and where you signed up for, and we'll get back to you on that. We also have a great website that has FAQs. You can also learn about our investment policies on there as well. But just wanted to thank everybody for showing up today. I thank you, Callan, for taking the afternoon during your lunch hour to come and talk to us about investing, and hope everybody gained a lot of knowledge. I know I sure did. We actually did have a question come in real quick. Can I have an ABLE account and a 529 college savings account for my child? That is correct. You're only allowed to have one ABLE account nationwide that's unique to the individual, but that individual, they can also have a college savings account that is acceptable, but if they and there are some rules that are different for college savings account, but yes, an individual can have both. And then we're in the process of hopefully being able to allow rollovers from college savings accounts into ABLE accounts. So stay tuned for that as well. Just want to thank everybody for showing up today. Our customer service contact information is on there, and we appreciate your time and willingness to join us on this webinar. And hopefully you will choose ABLE United to help you achieve a better life experience. And everybody have a great afternoon. Thank you, Weston and Brian, for joining us.
Thank you all.
Thank you. Thank you.